So before we get started, just for kind of context, this is where we're kind of sitting coming to this earnings session this quarter, I should say. Excluding the last week, which was basically flat, it was down 0.1%, which in a 5-day trading period is negligible. 3 weeks, last 13, has the market actually been up? That ties the number going back to 1928 on any 13-week period. Okay, so we've had a lot of bearishness coming into the market. Just to give one example, Microsoft is trading at a 12-year relative low to their trend. You have kind of some signs of strength, however, in the last week or so. The lows for the day have actually been in the morning, not in the close, which is actually a good sign, as typically on legs down, you tend to see higher volume and higher selling pressure heading into the close, as one day kind of snowballs in the other of negativity and downward pricing pressure. So that being said, let's kind of recap as we head into earnings. Go ahead and cue the intro. Right, so welcome to the earnings pod. We're going to kind of talk about a couple that have already occurred and look forward to some that we're going to be expecting to hear from. Delta Airlines, that was one. If you follow the pod, I had options in. The earnings came out. You had higher fuel and labor costs, which actually had them miss on the bottom line. That being said, they still had pretty strong revenue and quarterly profit numbers. 28-ish level is basically the 52-week low. If it gets down there and you're looking for an entry point, that would be a great entry point. With all the kind of revenge travel spend and these numbers coming out, you're still seeing very, very strong demand for activity and leisure and experiences in the consumer discretionary sector. All right. That being said, getting into consumer discretionary, we kind of had some of the banks, Citi, Bank of America, JP Morgan. So their loan, Citi, for example, and all these banks, you saw a lot of loan loss provision raising, which actually impacted their quarterly earnings for this quarter. That being said, it wasn't as negative as the street was expecting. So you saw a rally off the back of those numbers. JPM and specifically, you had their CEO, Jamie Dimon, coming out and talking about potential tropical force storms or hurricanes that would potentially hit the market going forward. What you did see is, in spite of this raising of provisions, you still are seeing very, very strong commercial loan growth. That's very critical for these guys. That's how they make a lot of their money, aside from their trading and their IPO and some of the other market activities they participate in. So the bread and butter for these guys is making spreads on what they bring the money in for as far as financing and what they lend it out to. Okay, that net interest margin, or NIM. So you hear that a lot, NIM. So that's actually increasing as the Fed's increasing rates. Because their NIM is higher, they're actually performing pretty well. So you saw that last week, the end of last week especially, you saw the banks rally really hard. I talked about Citi and specifically on my podcast a few weeks ago, around the 46.5, 47 level. If you got in at that entry point, I dropped a quick short when it was trading around 49.5 on Friday, basically citing that instead of looking to sell into the strength, I was actually looking to harvest some of the volatility and sell covered call options against it. All right. Oxy. So these, along with Chevron, Exxon, full disclosure, I do actually have holdings in this company myself. They are a oil company. They do exploration, all of petroleum byproducts, if you will, gas, etc. Earnings are expected coming out for their last quarterly report. If you listen to the call, they were discussing how they're basically doing their metrics and numbers based off $95 barrel in oil. I actually think that number is a little bit high, so I want to see if this earnings call, if they revise it down, saying that heading into the end of the year they're looking at $80-$85 barrel in oil, or if they're still sticking with that $95 number. Last quarter, these guys made roughly $5 billion in gross profit. You're expecting a very large number again this quarter, not quite as large, but you're expecting a very large number on them as well. Buy levels, you're looking at 58 to 60. I think if it retests that high at 70 and you're looking for a quick trade, that's a potential exit strategy right there. Depending on where you get in, if you get in the 58 level, you're looking at 20%. Could be potentially in a week or two on the back of their earnings. Same thing, OIH. So OIH is a conglomerate. It's kind of like an ETF. They are comprised of Schlumberger, Halliburton, a lot of these big names. Those two specifically comprise a lot of the index. Going into earnings season, I still see Schlumberger and Halliburton recording great numbers. I don't see a lot of these petroleum companies cutting the capex significantly as far as development of oil. So these guys, If you look at a chart specifically on OIH and you go to a 5-year, they're trading, especially relative to the price of oil, they're trading at a multi-year low. So I think you have a little bit of catch-up trade here. However, that being said, because of the volatility of the underlying asset itself, a la being oil, these guys I would look to play at going into the week upcoming with their earnings calls. Play it via 2-week option calls. If you like, you could even do a call spread and go from there. On the tech side, a couple of the two mega caps will not be this week. However, we do have them coming up shortly. Apple and Google. Apple, you have to look at hardware numbers, and you've seen as far as iPhone sales coming out of Europe, you've actually seen a decline. That's for obvious reasons. You have the war, and you have some sort of economic uncertainty over there in Europe, especially with energy and all these prices starting to rise and kind of pinch the average individual living over there. I do expect to see weakening iPhone numbers. The question is, are they going to offset that weakening hardware number with an increase of revenue as their services? And I think the end game for Apple here is they probably won't discuss on this earnings call, but basically kind of having a giant bundle where you pay monthly, $150 a month or so, and you get your MacBook Pro upgraded every 3 to 5 years. You get your iPhone upgraded. You have your iTunes account, and all that's going to be linked, obviously. Your Apple TV, all this stuff, and eventually I see them going that route. But we'll see what happens as far as specifically this quarter, their hardware sales, and if they have any weakening. We've already kind of seen month-over-month numbers in Europe slow down a little bit. Lightning round at Google. Relative to themselves, as I mentioned, they are trading at low basically since COVID, the depths of COVID. You back out their cash, they're trading at a future valuation of around 20. It's about as cheap as you're going to get on a company like this. What I'm looking for on them is the same thing with Meta. Ad spend. It's already starting to be predicted to be weakened. The numbers on the street are lower than what the earnings expectations were a few months ago. The question is that appropriate enough? Does the tape tell the correct truth in this case? Or are we going to be in for a surprise? Kind of like we saw when Micron released. They were already down. People had already downbeaten expectations, but when they took 20% or so off of their future quarter guidance, obviously the equity still suffered. Another one I'm looking at, for those of you who are in the fixed income as long as equity, HYG and LQD. So these are your bonds. HYG is essentially what we used to call pre-2008 junk bonds. So basically very low credit. These are not your AAA type companies. If you think about a company like Walmart or large blue chip company, when they go to issue debt, they are not going to be considered HYG, high yield or junk, as people are concerned of liquidation and potential defaults on their actual principal values. Okay, so the yields have been increasing. LQD, same thing. The last few weeks, they've actually kind of reversed trend a little bit here and have held steady. I personally, myself, full disclosure, am short these bonds right here. In case of some sort of credit event, it's kind of basically a hedge for my equity positions that I hold in my portfolio. So if any of you are looking for some cheap protection via the uncertainty that's kind of occurring in the market, potentially some shorts on the HYG or LQD will be an option to cover yourself. Another one I'm looking at, CX. So these guys are going to be report in about a month or so. They are the world's largest supplier of concrete, Europe, North America, Central America, etc. They concrete ag, finished concrete. So if you think of all the construction that's been going on the residential and commercial side, they are the direct beneficiaries. They've been consistently raising prices over the last year. Basically trailing 12 months, they've raised prices twice in a year, which is pretty unprecedented for them. Typically, your concrete markets are very stable. What I'm looking to see is, are they reporting issues in demand? So obviously, with these price increases, with increased borrowing cost, are they starting to see a softening in the developmental market, whether it be residential or commercial? Rivian. So full disclosure, I do have a position in this company as well. So in this kind of environment, are investors willing to pay for future returns? This company does not see a return of capital, not return on capital, but return of capital for the foreseeable future. They're spending money on basically development of plants, expanding their commercial, their vehicle line, and basically investment in their own company. Now, getting back to the stock, 30 is a key level. I think on the back of this earnings report and basically more or less the mood of the market, I think you're going to see whether or not this is a market where people are willing to accept this relative level of risk. It's in an industry that's well established, but it is a relatively new player with a very high valuation. If you're personally looking to get into the name yourself, 20 is going to be a very obvious entry point as you're approaching the 52-week lows, and that was when Ford announced that they were ditching their investment in Rivian to raise capital. That being said, deliveries are improving. We had a report come out a couple weeks ago, and you do have the Georgia plant that's going to be opening within the next year. Kind of in the same boat as Rivian as far as is the market willing to pay for very far dated future returns right now. You have Virgin and Galactic. The reason I put these guys in here is they actually had a recent deal with a Boeing subsidiary to basically increase the company viability long term, but it doesn't do anything immediate term for the stock. You have 2 more of the redesigned ships that they're going to be begin building, and according to them, space travel in 2023 is supposed to return. And with these refurbished ships that they're going to be using for the space travel, they're TBO, so they're time before overhaul, which is regulated by the FAA. So any commercial plane that is flown in the U.S. is regulated by FAA. So their TBO is going to be extended. What that means for them with these new ships is that they're going to be more economically viable, and they're going to need less maintenance. But again, getting back to the whole Rivian point, is this something the market's going to be willing to pay for years in advance of growth, but are they willing to pay it right now in the immediate term? The question still remains, and as of right now, the answer has been no. So, and then getting into the retail side, we have a couple that I'm looking at. It's going to be Nike and LULU. So Nike is your premier retailer. They already have reported earnings, and on the back of their earnings, they dropped down to 100. I mentioned in a previous video, if you're looking at Nike long term, that's a great entry point to get into. I still stand by that if you're looking at Nike long term. However, in this current market, I do think if we see any sort of softening in any of the consumer numbers or discretionary numbers, you could very easily see it go down another 15% from the 100 down to the 85 or so level. 100 where it was at pre-COVID, found support there after its earnings report and bounced off that level. But again, if we see any sort of deterioration in the consumer space, I think 85 is the level to go to. And outside of Nike, I would rather actually own LULU. I know it's very expensive. It's at 35 times, but it's a premier brand to an elite clientele. And that's very, very important. It can't be underestimated. Prior to 2008, you had the wealth to income ratio of the top 10%. It soared from 721% in 1994 to 912% in 2007. While the bottom 10% only improved 10%. So you see this bifurcation in the ability to spend and the wealth effect of the top 10% of earners versus everybody else. And Lululemon is obviously a premier brand that is targeting the more affluent buyer. So in a discussion between Nike and Lulu, I personally would rather own Lulu if you must own something in consumer discretionary space. And I also believe, just going back to the last recession, looking at those numbers, the affluent buyer will not be meaningfully impacted. So yes, their total revenues may come down, but it's not going to be impacted in the same way which Walmart, Nike, some of the more broad-based consumer product items will be affected. Next one up is StarBucks, a restructure with a new CEO. I love the stock, but in 6 months from now, not right now. They have $20 billion in debt, which is causing share repurchase and dividend ceiling to basically be kind of a hindrance in the short term. So put this on your back burner. Remember it. I think this is one you can hold off on for the next few months. Royal Caribbean, the whole cruise line, they're going to be reporting this earnings season as well. I think everyone's gut reaction to say, oh, they've been hammered by the pandemic. Royal Caribbean in of itself was trading above 100, and right now we're sitting very, very shortly above $30. I don't think that means it's necessarily time to buy. Long story short, if you look at the intrinsic value of these companies, they have not really changed. I mean, they've taken on so much debt that their share price is just a reflected of how much debt they've had to burden themselves with during the last 2 years. And it's such an extreme level that these companies are actually in danger of becoming zombie companies. Carnival Cruise Line is already potentially in this boat, and we saw this happen last quarter. And what that means, being a zombie company, is they have to issue new debt just to pay the interest on the debt that they currently hold. So I've actually been, full disclosure, been short since the mid 70s level. And I think this is one where if it hits that $20 range on Royal Caribbean specifically, if you really want to get into something with a high beta and kind of a potential short squeeze play, I think at the $20 level, this is where I would potentially look. All right, let's go a real lightning round on this one. We're looking at value trap or trade. So these are all companies that are going to be trading at a relatively low PE or discount to themselves, and discuss whether that was a trap or a trade. Costco, I think here is actually a value trap. I understand what everyone's saying as far as the potential inflation hedge for a consumer. That being said, it is trading over 30 times its future earnings value. Walmart, same thing, consumer discretionary. I think this is also a value trap. They sold off heavily after last earnings report with all the excess inventory. And I think as far as between Walmart and Target, Target actually has a lower dollar value of excess inventory. Walmart, I think, is going to be burdened by their poor management of the supply chain for the next couple quarters to come, and also potentially headwinds from consumer discretionary spending. Ticker symbol X, U.S. Steel is trading at less than 5 times projected future earnings. I think that's the tail of the tape is accurate in this one. I don't see earnings holding up. Steel prices are going to begin to roll over, I believe, as a lot of this heavy industrial construction and everything is going to be postponed. Shopify. So this one is not necessarily a quote-unquote value. However, relative to itself, it is trading at levels that we have not seen in the last 5 years, as if you look at it as far as price to sales goes. And so that's going basically back to pandemic level lows. Recently, JPM actually released a call on this one, and it called it the best-in-class commerce service, but yet was actually bearish to neutral in the article on Shopify itself. I personally believe this is actually a value trade, one where you can actually trade here. You could see potentially Fibonacci retracement up to the 45 level. Another value trap or trade here, we have Ford. Again, if you just look at it straight price to earnings ratio, it looks very, very cheap and attractive. That being said, I do believe this one's actually a value trap. They have over $15 a share in debt. And on top of that, they're going to be facing headwinds potentially as well, just as everyone else. We've already seen basically delinquencies and an uptick in vehicle loan defaults. I believe that's going to be a headwind to the car market heading forward as well. Last one on the list today, CRM. So these guys are obviously well known. Anybody with small businesses probably use them for obviously their client relation management, hence the ticker symbol CRM. I do see potentially SAS spend come down, and there are quite a few players in the space, and the valuations right now are kind of a little bit rich for my blood. I think this one right now is going to be a value trap.